Good day, everyone. Let us continue our discussion on counting cycle, steps 6 to 8. This is the second part of the discussion. Let us recall step 6 to 8. Step 6 is about preparation of worksheet, and we will be able to complete the worksheet since you already know how to prepare adjusting entries. Then after that, we'll prepare financial statements, okay, primarily the income statement, balance sheet, and statement of changes in owner's equity. Then after that, we'll prepare adjusting journal entries and we'll post that to the ledger, okay? Assuming that you have this worksheet, okay, Benji Auto Repair Services worksheet for the year ended December 31, 2023. So the accounting period of Benji Auto Repair is every December 31. It ends December 31, so it adopts the calendar period. And you have here the account title along with its code and the unadjusted trial balance and the other columns like adjustments, adjusted trial balance, income statement, and balance sheet. Okay, you will notice that the unadjusted trial balance also includes, okay, account titles with no balances. Okay, for worksheet preparation, you have to include all account titles used by the entity because that account may be affected by the adjustments that we will be preparing later. So let's assume that this is the unadjusted trial balance of Benji for the year ended December 31, 2023. Relative to the worksheet, okay, we also have here additional data for adjustments. Okay, as you can see, there are 6 items that you need to consider when you prepare adjusting entries. And since you already know how to make adjusting entry, so you will be able to prepare correctly adjustments for this 6 additional data. Remember that you have to ensure that your adjusting entry is correct because if you misinterpreted the additional data, it could affect your adjusted trial balance, and of course, that will also affect your financial statements, your income statement, or balance sheet. Let us start with additional data number 1. Assume that repair equipment was bought on January 1, 2023, while office furniture and fixtures were bought on July 1, 2023. The estimated useful life of equipment is 10 years with scrap value of 4,000. While office furniture and fixtures is 4 years with no salvage value, the entity uses straight line method in depreciating assets. Okay, to compute for the depreciation, you have to check your unadjusted trial balance to determine how much is the repair equipment and the office furniture and fixture. So we have here the portion of the adjusted trial balance, and based on the unadjusted trial balance, the amount, okay, recorded as office furniture and fixtures, okay, 14,000, and then repair equipment is 100,000. To compute for the depreciation, okay, let's start with repair equipment. Since repair equipment was purchased January 1, 2023, so our depreciation will start from January 1 to December 31, 2023. And that is 100,000, which is based on the unadjusted trial balance. That is the cost minus 4,000 scrap value or residual value divided by 10 years, which is its estimated useful life. So that will give you 9,600 annual depreciation. How about the other one, which is the office furniture and fixtures? Based on our unadjusted trial balance, the cost is 14,000. And since there's no scrap value or residual value, so that's still 14,000 divided by 4 years. So your annual depreciation for office furniture and fixtures is 3,500. However, for December 31, 2023, you will only take up one half of 3,500. Why? Because office furniture and fixtures, okay, as you can see in our additional data, was purchased July 1, 2023. So from July 1 to December 31, that's equivalent to 6 months or half year. So that's why 3,500 annual depreciation was multiplied by 6 over 12, and that will give you 1,750. So therefore, your total depreciation is 9,600 plus 1,750. Total is 11,350. And if we will post this adjusting entry to our worksheet, then we'll have this. This is the worksheet before adjustments. Since we already identified or computed for the total depreciation expense, so we will write or type under the adjustments column, debit column, depreciation expense, how much? That is 11,350. And then the credit entries, we have accumulated depreciation, repair equipment, 9,600, and then another credit to accumulated depreciation, office furniture and fixtures, 1,750. Next adjusting entry, the entity estimates that 3% of total service revenue is uncollectible. If you can still recall the method of estimating doubtful accounts, okay, so remember that whatever the amount computed based on total service revenue is already your doubtful accounts expense. This is in contrast with the percentage of accounts receivable in which the computed amount is the required allowance. In such case, or in such a case, you have to consider the allowance for doubtful accounts balance and determine whether that balance is a debit or credit balance. But since number 2 is based on total service revenue, whatever is the amount computed will be our doubtful accounts. Okay, let's have the amount here based on the unadjusted trial balance. Service revenue is 109,500. So how much will be the doubtful accounts expense? You just multiply. Okay, 3% times 109,500, and that is 3,285. And this is your doubtful accounts expense. And let us post this 3285 to the worksheet. Okay, this is the worksheet after posting adjusting entry number 1. Next, we'll post adjusting entry number 2, which is about the provision for uncollectible accounts. So number 2 adjustment, we have here debit doubtful accounts expense 3,285 here. And then you look for allowance for doubtful accounts, and that is a credit 3,285. Let's continue. Adjusting entry number 3 on July 1, the entity paid 36,000 for 12 months rent in advance. This is a prepayment. And you have to determine what method was used by the entity. It could be asset method or expense method. How to determine what method? You check your unadjusted trial balance. Okay. So what are the possible account titles that may be used by the entity, okay, for rent in advance or payment of rent in advance? So it could be prepaid rent or rent expense. Let's check if there's a balance under prepaid rent account. So there's no balance, but in rent expense, there is 36,000 pesos. So meaning the entity used expense method in recording rent in advance. So with that, you have to determine what should be the correct rent expense for the year ended December 31. So since it started July 1, December 31, if you will count July, August, September, October, November, December, so that's equivalent to 6 months. Okay? So your rent paid on July 1, which is good for 12 months, 6 months of which have expired or had expired, and the other 6 months, okay, unused or unexpired. So at the end of the accounting period, you have to reflect the correct rent expense, which is 18,000. So based on the unadjusted trial balance, it's 36,000. So it's overstated. So what amount should be recorded in your adjusting entry so that the ending rent expense or the rent expense at the end of the accounting period is only 18,000. And aside from that, you also need to record the unexpired portion of that rent, which is also equivalent to 6 months, and that is also 18,000. Okay, so let's go back to the worksheet and record the adjusting entry for rent expense. Okay, since the entity used the expense method in recording the payment of rent, okay, so adjusting entry should be a debit to what? A debit to prepaid rent. And based on our computation, the prepaid rent should be equivalent to 6 months rent, which is 18,000. Okay, how about your another entry, your credit entry? It should be rent expense, which is also 18,000. So in that case, you have the debit 36,000, okay, under the unadjusted trial balance, and you have an adjustment of 18,000 credit. So your rent expense at the end of the accounting period is now 18,000, which is the correct amount of rent expense. And at the same time, at the end of the accounting period, you recorded the unexpired portion of rent, which is also equivalent to 6 months, and that is also 18,000. Next adjusting entry, number 4, office supplies on hand at December 31, 2023 amounted to 500 pesos. Just like our previous adjusting entry, we have to determine whether the entity used asset or expense method. So what are the possible account titles that will be used to record the office supplies when it was purchased during the year? So it could be prepaid office supplies, which is an asset account, or office supplies expense, which is an expense account. Based on the unadjusted trial balance, the method used by the entity is asset method because prepaid office supplies has a balance of 2,000 and the office supplies expense has no balance. With that, we have to correct the amount of prepaid office supplies because at the end of the accounting period on December 31, 2023, it should only be 500 and not 2,000. So therefore, the office supplies for December 31, 2023 is the difference of your 2,000 and 500. So your office supplies equals 2,000 minus 500. So that is equal to 1,500. And then let us again post this to our worksheet. For office supplies, let us post our adjusting entry. Okay, we will debit office supplies expense 1,500 and then we will credit prepaid office supplies, okay, 1,500. So if this will be your entry, your prepaid office supplies at the end of the accounting period or on December 31, 2023 will be 500 because you have a debit of 2,000. You also have an adjustment of 1,500 and that will give you a 500 ending balance. And that is correct because based on the additional data, the supplies on hand is only 500. And what's the difference? The difference of 2,000 and 500 is actually your prepay or your office supplies expense, okay? Number 5, adjusting entry on December 31, 2023, 15,000 of salaries have accrued. So this is accrual of expenses. And as mentioned, our format, we debit the expense and we credit the payable. So this is how we record this accrued salaries. We debit salaries expense 15,000 and we credit salaries payable. And let us post this to the worksheet. For salaries, accrued salaries, okay, we will debit salaries expense, okay, 15,000, and then we will credit salaries payable, okay, 15,000 also. Last adjusting entry on October 1, 2023, the entity invested 50,000 cash in a certificate of deposit, meaning time deposit, that earns 4% annual interest within 1 year term to maturity. Let us compute how much is the interest income. Okay, so we have here 50,000 times 4%. That's annual interest. However, the entity, okay, deposited only last October 1, 2023 or on October 1, 2023. So from October 1, 2023 to December 31, 2023, that's 3 months. So we have here times 3 over 12. So for 2023, the interest income is 500. And when you record this adjusting entry, you debit the receivable and you credit income. So in this case, interest receivable and interest income. And let us post this to our worksheet. We are now on adjusting entry number 6. Okay, that's actually interest. Okay, so our debit is interest receivable 500 and credit is interest income. So at this point, we already posted all the adjusting entries. Our adjustments column are already, or adjustments column is already complete. Okay, and then we get the total debit and the total credit. Let's see if the amount of total debit equals total credit under the adjustments column. Okay, the total is 49,635, and the credit is also 49,635. Let's move on to the next column of the worksheet, adjusted trial balance. For this column, you will just incorporate the adjustments column and the unadjusted trial balance. Example, for cash, since there's no adjustment, this amount 115,949.75 will be extended to the adjusted trial balance debit column. So that's also 115,949.75. How about accounts receivable? There's no adjustment, so we will just copy the amount under the debit column, 15,000. And then for others, okay, so these are the balances that you will forward under the adjusted trial balance. Okay, allowance for doubtful accounts. We have an adjustment credit 3285. So you copy that amount to your adjusted trial balance until your last account title here with balance. So we have office supplies and expense 15 since there's no other amount, okay, no amount reflected in the unadjusted trial balance. So we will just copy the adjustment amount of debit, 15, then 15 to adjusted trial balance. Okay, so that's how you accomplish the adjusted trial balance. You will just combine your unadjusted trial balance and adjustments. But you have to take note of the balance of your account, if that is a debit or a credit. If your unadjusted trial balance is a debit and your adjustment is also a debit, what will you do? You will just add the two and the resulting amount is also a debit. What if the unadjusted trial balance is a debit and your adjustment is a credit? Okay, you will deduct. And then how about the side? Is it a debit or credit column? Okay, it depends. If your debit column is more than, or your debit amount is more than your credit amount, then it should be debit column. Okay, and vice versa. So after we have filled out this adjusted trial balance and you already got the total, then you can now proceed to the next column, which is income statement. For the income statement column, okay, you have to identify what accounts are included in this column. Since income statement relates to your revenue or income accounts and expenses, you will extend the amounts, okay, from adjusted trial balance to the income statement column. And I highlighted the account titles which are part of your income statement column. So you have here service revenue, interest income, salaries expense, rent expense, utilities, depreciation, doubtful accounts expense, taxes and licenses, and office supplies. Miscellaneous expense, no balance, so we don't have any amount to be extended. So for income statement, we will just copy the adjusted trial balance amount. Okay, so for service revenue and other accounts up to your office supplies expense, okay, you have 109,500, 500 interest income, your salaries of 35,000 debit up down to your office supplies expense amount, which is 15. Then after that, you get the total debit and the total credit. Your total debit is 74,935 and your total credit is 110,000. So you get the difference. Okay, 110,000 minus 74,935. So that will give you a difference of 35,065. And since your credit column is more than your debit column, that means there is a profit. Okay? And your profit is 35,065. And let's see if the same difference will also be reflected in our balance sheet column or statement of financial position, because that should be also 35,065. After we have determined the difference of our credit column and debit column of our income statement column, okay, so let us check if the same difference will be noted in our balance sheet, okay, column, okay. So for balance sheet, we will be including the assets, liabilities, and equity accounts. Again, just like what we did in our income statement column, we will extend the adjusted trial balance amount to our balance sheet. Okay. And this is the result. Okay, for cash down to your Benji Limhoco capital. So we extended the amount from adjusted trial balance to the balance sheet column. Okay, and then we also get the total debit and total credit. Your total debit is 282,700 and the total credit is 247,635. Okay, so since 282,700, your debit is more than your credit, so that means the difference is attributed to profit or net income. And if you will get the difference, this is also 35,065, the same difference in your income statement column. Okay, so we attribute that as profit or net income. Since we already completed the worksheet, we can now prepare the financial statements. First, we will prepare the income statement. So actually, we will just formalize the worksheet and make it a formal report. Okay, so I lifted the income statement column, okay, with account titles and balances because this will be the contents of your income statement. So again, we will just be formalizing this worksheet into a formal report. Okay, the format of income statement, you have, of course, the heading, the name of the company, the name of the statement, and this, okay, period for the year ended December 31, 2023, meaning this income statement, okay, shows the performance of Benji Auto Repair Services from January 1, 2023 to December 31, 2023. And as to contents, we will just copy the contents of our worksheet under the income statement column. So we have here service revenue, and then since we will be converting this into a formal report, so we have here add interest income, which is 500. The total revenue is 110,000, less expenses. And expenses, again, are lifted from the worksheet. So you have salaries expense down to your office supplies expense, and the total of which 74,935. Okay, 110,000 total revenue, less expenses of 74,935, that will give you a profit or net income of 35,065. So the same difference reflected in the worksheet. Okay, so that's income statement. After the income statement, we can also prepare, right after that report or statement, the statement of changes in owner's equity. And we have this format. Okay, you have the heading, the name of the business, the name of the statement, which is statement of changes in equity or owner's equity, and then for the year ended December 31, 2023. We start the report with Benji Limhoco Capital 1/1/2023 or beginning balance, or January 1, 2023. So there's no balance because the business was established only in 2023. And then add investment. And based on the worksheet, okay, the investment of Benjamin Hoko is 150,000. And then we will also add the profit, which was reflected in the income statement, 35,065. So the total is 185,065. Less withdrawals or drawings, no withdrawal, so 0. Therefore, the capital ending of Benjamin Hoko on December 31, 2023 is 185,065. So this is the statement of changes in equity or owner's equity. And then after this, what's next? Okay, we will be preparing the statement of financial position or balance sheet. The contents of your statement of financial position or balance sheet will also be lifted from the worksheet. Okay, so I have here the portion of balance sheet column of our worksheet. Okay, you have here the account titles. Okay, you have the cash, those accounts which are part of your assets, liabilities, and equity. Those are part of your balance sheet accounts. Okay, so let us formalize this worksheet containing balance sheet accounts. and make it a formal report. And we call that statement of financial position or balance sheet. This is how the statement of financial position or balance sheet looks like. Okay, this is again a formal report. And similar to the previous reports, we have the heading, the name of the entity, the name of the statement, which is statement of financial position or balance sheet, and the period, which is December 31, 2023, or as of December 31, 2023. Why December 31, 2023? Because this statement reflects balances from day one up to the current accounting period. And the accounts that we will include in our statement of financial position, again, are from the worksheet, and we will categorize those accounts as current assets, non-current assets, current liabilities, and owner's equity. Okay, so for our current assets, we categorize cash, accounts receivable, notes receivable, prepaid rent, prepaid office supplies as part of your current assets. And then in your accounts receivable, you will notice that there is a contra account. That contra account is called allowance for doubtful accounts, and this is actually deducted from your accounts receivable. And the difference is the net realizable accounts receivable. Okay, so we have here cash, the net realizable value, NRV, of your receivable, notes receivable, interest receivable, prepaid rent, and prepaid supplies. These accounts comprise the total current assets, which is 165,415. And how about non-current assets? Okay, we have office furniture and fixtures, okay, plus accumulated depreciation. Okay, and we call that book value. Okay, for office furniture, it's 12,250. And then for repair equipment, that's accumulated depreciation. Okay, the book value is 90,400. So the total non-current assets is 102,650. And then you will get the total of your current assets and non-current assets. So your total assets is 268,065. And then we go to the liability section and owner's equity section. For liabilities, we only have current liabilities, and we categorize accounts payable, notes payable, and salaries payable as current liabilities. Okay, for notes payable amounting to 60,000, the payable is actually to be settled within 1 year. So that's why it's included in current liability section. However, if your notes payable will be settled beyond 1 year, then the classification will be non-current liabilities. But at this point, since this payable, notes payable will be settled in within 1 year, then we included it as part of current liabilities. So the total of these three is 83,000. And then we go directly to the owner's equity, and we only have one item, which is Benji Limhoco Capital. Okay, the amount that will be reflected in your owner's equity is the ending balance of your capital, or the capital account, which you computed in the statement of changes in equity. The ending balance that was reflected in the statement of changes in equity is the amount that you should reflect in the statement of financial position. And if you can still remember, in the statement of changes in equity, the ending balance of capital account of Benji is 185,065. So if we get the total, so the current liabilities of 83,000 and Benji Limhoco Capital, so the total liabilities in owner's equity is 268,065. So they are equal. We are now on step number 8, which is adjusting journal entries are journalized and posted. Remember what we did in our worksheet? We directly posted the adjusting entry, okay, to the worksheet. And remember that worksheet only facilitates preparation of financial statement. The worksheet is not the journal, it is not the ledger, nor it is the financial statement. So therefore, the adjusting entry that we posted in the worksheet should be recorded in the general journal. And that entry should also be posted to the general ledger. And I'll be showing with you the summary of our adjusting entries. we prepared 6 adjusting entries, and that entry should be recorded in the general journal. And as you can see, the PR column or posting reference had already filled up or was already filled up. So meaning this account, depreciation expense, and all other accounts that we used in our adjusting entry were already posted to their corresponding ledger. At this point, I'll be sharing with you two of the general ledger accounts. Okay, so just to show you that the adjusting entries were already posted to the general ledger. Okay, so we have here depreciation expense account. And for the particulars, as you can see, we type here or type here depreciation for the year. The JR is J-20 or GJ-20. J is journal, GJ is general journal. So either of the two. Then debit is 11,350 because the depreciation expense for the year is 11,350 and it's a debit. And then we get the balance. Okay, 11,350 is also the balance. And then next we have the doubtful accounts expense. Okay, the date of adjusting entry is December 31, 2023. The explanation or details of the doubtful accounts expense is provision for uncollectible accounts. Okay, journal reference is the same as the depreciation expense. The amount entered under the debit column is 3,285 because that's the amount that we estimated to be uncollectible for the year. And we get the balance, and the balance is 3,285. So at this point, that ends our discussion for adjusting journal entries are journalized and posted. Okay, and next video lecture, we will discuss the remaining steps of the accounting cycle. We still have steps number 9, 10, 11. And once again, thank you for watching this video. If you like this video, share this video and subscribe to my YouTube channel. Thank you.